Thanks for joining us. Thanks for taking some time out of your busy days to spend some time with us, going over the economic outlook. And as Sherry mentioned, I'm going to spend about the next 10 to 15 minutes or so, basically setting out the big picture view. How financial markets are gauging this recovery, and then landing on what it might mean for the Canadian economy as a whole. And then I'll hand over to my colleague Robert Kavsik to dig into some of the details, what it means for Ontario more specifically. So I have to start with everybody's least favorite topic, and that, of course, is the virus. On that front, there has been some good news in recent weeks. We have seen the number of new cases come down and come down aggressively right around the world. This chart does look at it on roughly a per capita basis, so you can get a sense of how Canada is faring versus the big five European economies and the US. And the story there is that it really does look like the second wave crested pretty much around the world in the first half of January. Now, there is a bit of, there are a few cautionary notes here. First of all, as you can see in Canada, it looks like the progress has stalled out. If anything, the number of new cases actually backed up a little bit in recent days. And of course, there's also the concern about the new variants, which do seem to be taking over center stage at this point. But again, from a very big picture, we've seen a sharp decline in new cases and new hospitalizations as well. Of course, offsetting the recent somewhat less good news on the number of new cases is the vaccine news has generally been positive in recent weeks. It does look like after a slow and stumbling start here in Canada, the pace of vaccination is going to pick up markedly. Now, just this morning, we got some concerning news about the AstraZeneca vaccine and the fact that some Scandinavian countries are halting that. But I would point out that's just one vaccine and is quite different from the others. So I don't think it changes the broader landscape. I guess I would be concerned that it might actually increase vaccine hesitancy a bit. But at least to this point, hesitancy really hasn't been a big concern. We've actually seen the lineups. We've seen people in some cases actually trying to jump the queue. So hopefully this doesn't significantly alter how many people ultimately get the vaccine. We have been assuming that the vast majority of US adults will get a vaccine by June and in Canada by September. If anything, the news in recent weeks looks like that timeline's way too cautious. President Biden has actually talked about all Americans possibly getting the vaccine by as early as May, and some premiers are now aiming at the adult population in their provinces getting it by the end of June. So it may well be that we've actually underestimated or been a little bit too conservative in our assumptions around the vaccine. But again, the important news is, we have seen quite a pickup in supplies recently, and it does look like the pace is about to pick up in a meaningful way. Now, financial markets have basically built in a very strong recovery at this point. They're looking well beyond the pandemic. They're looking 12 and 24 months down the line, and what they're looking at is a very robust recovery. This is a message we're hearing right across the board in financial markets. It's not just the equity market, and as we speak, despite that vaccine news overnight, we've got the TSX at an all-time high, a new all-time high. The Dow has also been at a new all-time high today. Yes, tech stocks have corrected in the last couple weeks or so, but even they look like they're beginning to firm again. And this is not just a North American story. It's not just a technology stock story. This is a very broad-based rally we've seen in global equity markets. It's gone way above and beyond just repairing last spring's damage. The market is clearly signaling quite a strong recovery. And again, it's not just equities. We're seeing it also in corporate bond spreads, which are, after a spasm last spring, are basically back to pre-pandemic levels or even lower. And this is a very important signal for economy watchers. The corporate bond market is a very good leading indicator, and what it is pointing to is a solid rebound. And finally, commodity prices, which I don't have charted here, but to me, if anything, that's been the most impressive recovery at all. Given the fact that we've just been through the deepest downturn in the post-war era globally, to have commodity prices completely reversing last year's damage, and that in fact, in some cases like lumber and some base metal prices getting to all-time highs, is just extraordinary news. And it speaks to the very rapid recovery we've seen in things like the purchases of big ticket items in the manufacturing sector, the extent to which, in construction as well, the extent to which commodity prices have been able to recover. Now, another market that's also pointing to a strong recovery is the bond market. In recent weeks, we've actually seen quite an upswing in long-term interest rates, and not just in the US and Canada, right around the world. And a lot of that is related to the view that the bond market too is beginning to fully price in quite a strong US and quite a strong global recovery in the year ahead. We believe that the bond market is almost completely priced in a robust recovery, and so we actually don't see much further upward movement in bonds from current levels. As we speak, 10-year yields in Canada and the US, 10-year government yields are close to 1.5%. That's basically where they were before the pandemic began. Not really that different from just over 12 months ago. We do see a little bit of further headway for these yields, but we think the big move is actually already behind us. Now, for shorter term interest rates, the rates that the central banks can more directly control, the overnight interest rate, which leads to variable mortgage rates and affects prime lending rates. These rates we think will be steady for quite a long period of time. It was almost exactly a year ago that both the Bank of Canada and the Federal Reserve cut these rates to the bone, essentially as low as they thought they could take them, and there they have stayed over the last year. We think that both the Bank of Canada and the Federal Reserve will be extraordinarily patient before they start to raise these interest rates. And we heard that message again just yesterday from the Bank of Canada in their latest statement, where they said, admitted, yes, the economy has done better than they expected. They're still concerned about the underlying weakness in the job market. And the bank basically reinforced the message that they are going nowhere fast. At this point, we're officially looking for the bank and the Federal Reserve to hold interest rates where they are until the middle part of 2023. There is a slight risk they could go a little bit earlier than that, but I'm here to tell you that if they go earlier than 2023, that is phenomenally good news. That means absolutely everything has gone right in the world in the next 2 years to get the Bank of Canada and the Federal Reserve to raise interest rates sooner than 2023. Now, so one common question I get is, well, with policy this extraordinarily stimulative, with this comeback in commodity prices, with a relatively robust economic recovery rolling our way, are we not risking a bit of inflation at this point? And it is true that inflation risks are probably a little bit higher now than they were before the pandemic began, which is a very unusual situation to be in. Again, think about it. We've just been through an incredibly deep economic downturn, and yet inflation pressures have reemerged from that a bit higher than they were before. Again, a lot of that goes back to the fast rebound in commodity prices and the massive degree of fiscal and monetary stimulus we're seeing. Now, it seems a bit strange to be talking about upside risk for inflation when headline inflation in Canada right now is at 1%. It's a little bit higher than that in the US, it's a bit lower than that in Europe. It's actually negative still in places like Japan and China. But in the next few months, we're going to get some pretty impressive, meaty headline inflation readings. And a lot of that is because we'll be comparing ourselves to the extreme situation of last spring when prices tumbled in the early days of the lockdown, especially things like gasoline prices, but some other prices tumbled as well. Um, Combined with the big bounce back that we've seen in gasoline prices recently, and we are likely to get a little bit of a burst in headline inflation in the next 3 months or so. In Canada, we think headline inflation will temporarily get above 3%. In the US, we think it could get as high as 4% in the next few months. The important message I want to leave you with, though, is we don't think that that's going to be sustained. We think that it will prove to be a passing phase and that inflation will settle back to just a little bit above 2% on average this year and similar that course next year. Looking out 3 to 5 years, I still think it's reasonable to assume that inflation will average about 2%. But again, I have to admit that there's a bit more upside to that view than there's been in the past. As I said, essentially, the central banks have told us that if they're going to make a mistake, it's that they'll keep interest rates too low for too long, and even risk a little bit of inflation in the years ahead. Now, I do want to spend just a minute talking about the Canadian dollar. And one of the reasons why, we're even talking about a bit of upside risk to inflation is this rapid comeback in oil prices. Last spring at one point for a couple of days, we actually had negative oil prices, something we've never seen before. Well, those days are well in the rearview mirror. We've now, because of very impressive supply discipline among OPEC, we've got oil prices back above $60 a barrel. That's actually higher than it was a year ago. That's higher than it was just before the pandemic began. We think some of this is a little bit overstated. and that oil prices will edge their way back down. But we're assuming an average oil price of $60 a barrel this year. That's a big supportive factor for the Canadian dollar. It's a big reason why the Canadian dollar has made such a quick rebound over the past year. During the turmoil last spring, the Canadian dollar actually fell below 70 cents at one point. We're now close to 80 cents. Looking ahead, we're not especially bullish on the Canadian dollar. We think the Canadian economy has a lot of medium-term competitiveness challenges, but there are a lot of important tailwinds behind the Canadian dollar at this point. Global tailwinds, things like robust commodity prices, uh, an oncoming solid global recovery, always good news for the Canadian dollar. And just the outlook for the US dollar itself is a bit mixed at this point. The US dollar has been actually quite weak for the last 10 months. That's been one of the key reasons why the Canadian dollar was able to rebound so quickly, is a more broad weakness in the US dollar. Looking over the next 12 months, we think these factors are largely offsetting. We think the US dollar will stabilize over the next year. On balance, we see the Canadian dollar grinding a little bit further ahead, largely on the basis of a very strong global recovery. So on that point, my last two charts are on the growth outlook. Starting from the very big picture on the global outlook, first of all, I have to, put it in context. We're coming off again the worst year for the global economy in the post-war era. It fell by almost 4% last year. We've never seen anything close to that since the Second World War. And every single economy in the world was caught up in this. Every single economy went through a global downturn last year. Now, that was last year. Looking into this year, we expect every single major economy to see quite a strong recovery. Now, there will be variations as we go up and down the list. Some got hit harder last year, and we'll see a bigger rebound this year. Some are more reliant on the service sector and tourism, and will be slower to recover. And I'm thinking places like the Caribbean and Europe on that front. But we think every major economy will see solid growth of some sort this year. And for the global economy as a whole, we're looking at 6% growth, a very strong year, well above average. And we see some of that flowing over into next year when we think growth will be almost 5%. So the last chart is just on, for me, is on the North American outlook, what that means. And we actually just overnight revised up our growth rate on the US economy. Largely that small upward revision, we've added a 0.5% to both this year and next year to the US economy, is because of the stimulus package that's about to get signed into law by President Biden, and the checks will start flowing out the door. When Biden first proposed 1.9 trillion in stimulus, we thought maybe 1 to 1.5 trillion of that would get through Congress. Instead, it pretty much went through as Biden asked. That is an enormous amount of money. It is going to give a powerful upward push to an already reopening US economy. We may well be conservative looking for 6.5% growth in the US this year. And by the way, 6.5% growth would be the strongest growth performance in the US economy since the Reagan boom back in 1984, which was led by the enormous tax cuts, another big stimulus package back in the early and mid 1980s. Now, what does this mean for Canada? Well, it's unambiguously good news to have our biggest trading partner growing at better than 6%. Just last week, we upgraded our call on Canada to 6% for a year, and that would be the strongest growth pace in Canada since 1974. Three big reasons for our relative optimism. One is that strength in the US economy. Second is that strength in commodity markets, which is leading to a much better outlook nationally. It's having important consequences, not just to firms' bottom lines, but actually to supporting real activity in all the commodity producing regions. The third factor is just the starting point is better than we expected. News just came out last week that the Canadian economy managed to grow at almost a 10% annual rate in the fourth quarter of last year, and it still managed to grow in the month of January. Think about that. January was in the heart of the second wave. We were still facing incredibly tough restrictions in Ontario throughout January, and we still managed to grow. It's mostly because sectors like construction and housing, resources, and manufacturing were still able to grow even during a very, very challenging time for small businesses and the service sector and the retail sector more specifically. So the goods producing sector, the big heavyweight industries, managed to offset that temporary weakness in the services sector. As services begin to reopen this year, we do believe that the Canadian economy will come back fairly powerfully through the later stages of this year. And by the way, just to put this forecast into context, we're not wildly out of bounds with other forecasters. Many others we think will be in the range of 5 to 6% as well. And we think some of that strength will flow through to 2022. So just wrapping it up, big picture story is we do believe that the economy is poised for a relatively solid rebound over the next 18 months.